Good day, everyone. Rich Griswold, Griswold Capital Strategies, and coming to you with the word of the day. It's pivot. If you've talked to friends, family, coworkers, turned on financial news networks, social media, inevitably over the last several weeks, you've probably heard the word pivot come up. And I believe the word pivot, in reference to Federal Reserve monetary policy, has um, different definitions depending on who you talk to, or at least different interpretations of what it means. So right now, all the focus is on the Federal Reserve's December meeting. Forget about the November meeting, where it's highly anticipated that they will raise interest rates again by 3/4 of a point. So we're looking out to December, and the market seems to be getting giddy about the idea that instead of raising 3/4 of a point in December, they will only raise by 0.5% or 1/4%. And it gets kind of this rumor mill going, and people get all riled up, and markets rally when they think there's a pivot coming, and then economic data that is shows that the economy is doing well or inflation is still hot, then the market sells off. Creates a lot of fear and greed, stuff that we absolutely hate here at Griswold Capital. The one thing that I'm trying to set straight in this video is that our idea of a pivot is very different than what I think a lot of Wall Street firms interpretations of it, of the word is, and also what the financial media is portraying. Our idea of a pivot is where the Federal Reserve will actually come out and say we're done raising interest rates, and that the next step will be, as the economy weakens, they'll start to cut interest rates. And the reason I say don't hold your breath here, if our definition is correct, is that we, outside of something catastrophic happening in the economy or the global economy, it's going to be a while. And I wanted to put some perspective in this onto this whole idea of the pivot, because while the word pivot might be cute and funny in, say, like a 90s hit sitcom, hearing it on the news and the way the markets react and what it potentially is causing in people's portfolios, and the emotions and the fear and the greed and everything, can be extremely frustrating from my end here. So once again, wanted to put some perspective on this historically, because we are in a bit of a new phase or a new era here, where over the last, pretty much the last decade and change, we've had a Federal Reserve that has been extremely accommodative. We've had interest rates near zero. We've had massive fiscal stimulus due to COVID, massive money printing, which has helped carry the stock market, real estate markets much higher, and we've become accustomed to this. Whenever the market gets in trouble, the Federal Reserve comes to the rescue, and we're in a different period now, and want to go back to the financial crisis, 2006, 2007, 2008 time frame. Not that I'm drawing comparisons to now versus the financial crisis, but at that time the Federal Reserve was on a campaign of raising interest rates. They stopped raising interest rates and then eventually cut interest rates. And I wanted to give a kind of a timeline of what that looked like back then, because it's easy to forget. It's been 15 years. So 2005, 2006, Federal Reserve is raising interest rates, tightening monetary conditions. Economy is doing well. Housing market, obviously, back then was doing extremely well. Federal Reserve does their final interest rate hike in June of 2006. So it's early 2007. So now remember, bear in mind here, so what we're talking about is about 7 months, 6, 7, 8 months after their last interest rate hike, where the economic data was starting to concern them. They actually acknowledge that the data was weakening, just because they're looking at it all the time. unemployment's on the rise, the housing bubble's finally starting to burst. It wasn't until September of 2007, you got to fast forward to the latter part of 2007, when the Federal Reserve finally acknowledged that things were so bad that they had to go in and cut interest rates. Fast forward to 2022, let's look at where we're at right now. Federal Reserve is still raising interest rates, has plans on raising interest rates. Inflation is still hot. Economic data that's coming in right now is still relatively strong. They have no reason not to continue to raise interest rates because inflation is a massive problem. Much of it created by the Federal Reserve and the massive fiscal stimulus we saw the last few years. But they've kind of created this monster. It's gotten out of its cage, and now they're trying to contain it and get it back in its cage, and they're not doing a very good job of it so far. So we have a Federal Reserve today that is continuing to raise interest rates. We're just wondering when they're going to stop the same aggressive pace that they're at or on right now. We haven't even gotten to the point where they're talking about not raising interest rates anymore, much less cutting interest rates, which again, outside of some kind of a massive economic dislocation, something globally happening in the economy, that's probably down the road a number of months from now before they even talk about cutting interest rates. From a market standpoint, from a stock market standpoint, wanted to put this in some additional perspective to give you a sense. I'm a visual person. I like to look at things like charts and stuff. And this is a chart of the S&P 500. What I've noted here with the little arrow is that was when the Federal Reserve first cut interest rates in September 2007. And as you can see, the stock market was giddy over that because the stock market, at least on a very short-term basis, likes lower interest rates, helps liquidity, etc. Well, it would go on for about another 4 weeks or so, make all-time highs. But once again, we were just coming to terms with an economy that was starting to roll over and worsen and worsen and worsen. And the stock market eventually reflected that over several months into the future here. October of 2007 all the way to March 2009 is when we actually saw the bottom, and we had a 57% drawdown from peak to trough. Once again, not trying to draw comparisons to the great financial crisis to 2022 and that somehow they're apples to apples. Time will tell whether that's the case or not. But what I'm getting at is that you have a retirement that's at stake. You have philanthropic endeavors that are at stake, a legacy that you're building to try to leave to children and grandchildren. And what I'm getting at here is that we have to plan for the possibility of things getting worse in the markets. And what is that plan? And so if you don't have a portfolio at Griswold Capital, I would I'd implore you to talk to your financial advisor, your investment advisor, about what the plan is. And that plan should not be, you got to hang in there, we're in it for the long run, you're diversified, you can't time the market. I've heard it all, and it's a bunch of baloney. It's lazy asset management, and you're paying your financial advisor, your investment advisor, a fee to do this. So they have no right to be lazy about this because you got a lot at stake. Here at Griswold Capital, we have all the flexibility in our portfolios, which is very exciting because we can be 0% cash, 100% cash, 0% in the stock market, 100% in the stock market, bonds, etc. Typically, it's somewhere in between all of that. Also, we have the ability to take advantage of lower prices, in that if there are sectors in the economy that we do not like at any given time, case in point today, we don't like financial stocks. Banks typically don't do very well in a recession. High yield debt, small cap stocks. we can actually use inverse ETFs to benefit from lower prices in those indices. If you'd like a consultation, another opinion, again, if you don't hold money at Griswold Capital, do not hesitate to reach out to me. I think it's a very important time to have another opinion about things. Here is my contact information. Happy to assist, happy to chat, address your questions, your comments, concerns. If you're an existing client, of course, do not hesitate to reach out anytime to chat about things. And then here is the disclosure for you to read. With that, wish you all the very, very best. Take good care and look forward to my next video.